Hello, everybody, and welcome to the Catalyst Funding Real Estate Market Update for September 2024. Great time to be in real estate investing. A lot to talk about based on the latest news, and I'm excited to introduce to you today the founder and CEO of Catalyst Funding, Wade Comeaux. We'll get everybody unmuted here. And then, Wade, glad to have you.
Glad to be here.
And we got Jeff Johnson, our Director of Lending here at Catalyst Funding.
Hello, everybody.
And today our special guest on the show with Bowden Appraisal Group, we have Eric Bowden. So glad to work with Eric and then also have him as a special guest today. So I'll kick it over to Wade to talk about our relationship with Bowden Appraisal Group and give a little introduction here on our special guest, Eric.
Yeah, thanks a lot. Very excited to have Eric here today. He is the leader of an appraisal group that we work with a tremendous amount here in Houston. And the thing I'll say about Eric is if you're looking for an appraiser, he and his team are outstanding, very responsive, very knowledgeable, very accurate on their appraisals, and just very helpful in every way possible. So as far as our personal relationship and working with them, if you're looking for an appraisal, I would definitely encourage them. But in addition to that, I find him to be one of the most knowledgeable people on the real estate market that's out there. He's also an agent, but he just understands real estate trends, how values are established, how to understand what's going on in the marketplace. And whenever I have a question about appraisals, appraisals of the market or whatever, he is the person I reach out to. So very excited to have him today. And I think you're going to see the information and wealth of knowledge that he can bring.
For sure. Just to add a tidbit, I spoke with Eric, it was yesterday or the day before, but we had a super rush come through and Eric was very accommodating. His team is always very helpful. So if you're in the business, hard money, and you need stuff done fast, not that Eric's going to do it every single time, because, you know, if every deal is a 2-day turn, then you probably have no employees left. But when it matters, Eric and his team come through in the clutch. And also it's a family business, is it not, Eric? I know your brother works with you, and I thought your father as well, right? Or used to.
My grandfather started it, actually. So okay. I'm third generation owner. I've been in business over 31 years now. Yep.
Wow.
Great.
But I appreciate all the kind words, guys, and it goes both ways. You're an incredible firm and responsible firm. And we love working with you guys too.
Awesome. Well, let's dive right into it. I'll quickly go over the disclaimer just so everyone, as a reminder, remembers that we are just providing our opinions today. We're not providing investing advice or any other type of advice. So you need to make your own educated decisions on your real estate investments, and no one on the webinar here today is giving you any specific advice on your own investment decisions. Going to the next slide, talk a little bit about our value proposition at Catalyst for those who are not familiar. We really take a lot of pride in being a one-stop shop for both hard money and permanent financing loans. We provide hard money to fix and flip properties if you want to be a flipper, but we also provide money to fix to rent properties. And we have a very integrated process where we have a single point of contact for all your loans. So one loan officer, one credit pool, and you have the broadest group of products available for you as a single family and small multifamily investor. We're also real estate lenders built by real estate investors. So I own a pretty good sized single family portfolio of my own. Many of the people on our team, including a person you would interact with very often, George Gibbons, our project manager, has been with us for about 10 years. And also owns a large single family portfolio of his own. So he brings that knowledge, we bring that knowledge, try and help everybody in the phone succeed. Another big thing at the moment is rates have really come down. We're going to talk about that a little bit more. But if you have any non-owner occupied rental properties, or if you own a primary residence, this is an excellent time for you to take advantage of that equity to fuel real estate investment. You'll hear a lot of the gurus talk about how having debt equity in your home is a waste, and you want to put that money to work so that it's doing things for you. And the best way to do that is to take it out as equity through a home equity loan that can help you invest in other properties. So if you want to talk about that, or any of the other products we talked about, we'd love to hear from you over at Catalyst.
Yeah, if I may, I just want I hear this often. We do hard money, obviously that's our main focus, but we also do, like you said, long-term loans, and it doesn't have to be just the projects that we finance. If somebody owns a home they live in, or they own rental properties, and we'll talk about the equity numbers in the past, but we can do those cash out refis on standalone. It doesn't have to be just a hard money loan. So if you own a property and you want to pull cash out of it, by any means, reach out to us. We can help you. It doesn't have to be one of our projects. So I hear that a lot, that it's got to be one of your deals. So I just want to clarify. It doesn't have to be one of our projects. If you own a property, give us a shout. We can talk to you about if it makes sense to pull cash out.
Absolutely. All right, let's go to our first slide of the presentation. And Eric, as the most knowledgeable person I know on the market here in Houston, I'd love to hear your insights on what you see on this first slide. Like, what jumps out at you?
Well, the first thing I see is the home sales, the amount of sales going down slightly. I have seen that of recent, right? Likely due to some of the interest rate concerns and also timing, market timing. So, outside of a summer period, family neighborhoods usually take a little dip. Although I do see that it's not, substantial, like huge numbers here, but I have seen that. And also recently, since the rate drops, which Wade you just mentioned, I've also seen privately an uptick of transactions and orders here at my company, orders inside of my real estate investment portfolios as well. Active listings, I'm looking at that. I also can agree with that. The listings are going up. I think they will likely stabilize as the buyers pick up. But I have seen the active listings kind of up and down and slightly on the upper side for quantity in our market.
Yeah, for sure. And I think we just to remind people who've not been on the call before, or to tell people who've not been on the call before, we have August of 2019 is like a pre-COVID time frame. So we're trying to show pre-COVID
Sure.
and then 1 year. And to your point, while the total sales is down a little bit from August of 2023, it's down significantly from the pre-COVID time. But the total active listings is closer to a normalized market. It's really down in August of 2023 because there's some more velocity in the market. But what really has impressed me is how this Houston market has stayed so stable on the home prices despite a massive increase to interest rates. So if you look at that since COVID, up 35.9% on average, 35.3% on median, and year over year also relatively flat in both categories. So as far as looking at the inventory numbers and the trends, from a normalized market back pre-COVID, 4.2 months of inventory, we're at 4.5. That's creeping up from where it's been recently, for sure. 1 year ago, it's far less. And if you look at the days on market, we're still down from that pre-COVID period and up just a little bit from last year. But what that's telling us is that it's a little bit slower market. The midpoint of what everyone would say is between a buyer and a seller's market is like 6 months. So we're still well below that. And I continue to think that as rates come down, I would expect in the next few months, even going into the winter with rates coming down, because there's a lot of pent up demand, I think we should see improved average and median home prices as rates come down. Jeff, anything else?
Yeah, I mean, it's like you said, about Houston in general relative to the rest of the state. It's kind of the steady eddy. You don't have massive upswings like you would say in Austin or Dallas, but you don't have really any kind of downswings either. It's very consistent. I mean, if I look at this month, for example, not to spoil it, but when we get to the other slides, Houston is the only city that has increased prices, right? It's minor, but it's the only one. Dallas is down a little bit. They had a massive run up. San Antonio's down, Austin's down. So like Houston as a bet is the most consistent and stable. I am curious, and like you said, rates are going to drop, or they're dropping, and that brings in a ton of buyers, like new buy. As rates go down, more people are eligible and can afford to buy a home. So you would think prices are going to go up, but it's already so unaffordable for the regular citizen. It's just kind of hard to say what's going to happen, right? Or yeah, I don't know, Eric, if you have
we're all we're all speculating there, but I see, hundreds and hundreds and hundreds of transactions a month. My speculation is a continue steady Eddie, like you said, Jeff, but that absorption rate going down. So there, the access of those new buyers are going to bring down some of that extra listing inventory, right? And balance. I think it's going to balance the market even more.
One other thing I wanted to mention, we didn't talk about this, if you look at the bottom, and it's relevant because we discussed this with people a lot, talking about pulling cash out of equity to buy more rental properties. And sometimes the cash flows to begin aren't the greatest in a higher rate environment, but there's positives working in your favor at all times. Typically, rents go up. Now, they don't go up every single year, but they're consistently over time. It's a pretty safe bet. Your rents are going to go up at a much greater clip than, say, taxes and insurance. And you always have the ability to refinance if and when rates go down. So if you look at that bottom number, the average lease price, I think a year over year, it's up $50. But, over the last 5 years, what is it? I think it's almost $500. It's gone up. So it's, people see, hey, I have a good rate. I don't want to lose that. But if you think long term and you think about, okay, I'm going to take that money and deploy it to buy more real estate, over time, those temporary measures where your cash flow isn't great, it gets better. It only gets better. Like, it doesn't get worse. Rents aren't ever going to just magically plummet, right? So a lot of folks are hesitant because of the low cash flow numbers. But if you look at it, give it enough time, it almost always makes sense. And that just right there, that 5 year, $500, that's kind of what we talk about. Hey, rent's going to go maybe $100 a year.
Yeah. Yep. So let's check out the next slide on Dallas. Jeff, why don't you tell us what you see here, bud?
Sure. So home sales are down slightly, as is total volume. Listings are higher than they were last year. They are about at the same level as they were, pre-COVID. Average sales price, like Eric said, is slightly down, not a big move. Down less than 1%. When you compare that to the overall, 5 year number, Dallas has had an incredible run up, almost 60% basically over the last 5 years. Median prices, same story, just smaller numbers basically. The months of inventory is at 4, which compare that to the rest of the state, it's actually still the lowest in the state. So that's still very positive. Days on market up to 49. Again, Houston and Dallas 47, 49. San Antonio, Austin are a little higher. But then same thing I just said regarding the rents. Look at the rents. They're up over the last 5 years. That same 5 years we talked about, Houston was up almost 500. Dallas is up $750. That is just a massive increase. So if you bought a property in 19, you didn't have to do anything to it, right? The natural rent should go up $600. So when you're talking about cash flows, just always keep that in mind. Typically, things are going to get more in your favor, right? If you're buying rental properties. Eric, anything here that looks unique?
No, this all looks correct. I don't know the Dallas market as well, but as you were walking me through it, I saw the same items.
Yeah, Dallas is a pretty incredible story. It was lagging Austin a few years after COVID. After that initial 3 year period after COVID, it was lagging, but Dallas has just stayed incredibly steady. It's had minimal drops here recently, but that 59% number is an incredible success story.
I can get behind Jeff as well on my own knowledge of the Houston market, which sounds like it translates well over here to Dallas as well in many aspects. But I do, a ton of work for rental grids and things like that, where we're trying to estimate what a property is going to obtain in a monthly rent. And I've seen the same thing, Jeff. Not just to back up the data that you've got here. Substantial returns have occurred over those 5 years, and that's a normal trend, right? I think that's what you're trying to hit, is that is a quality return that is mostly expected and is seen over and over and over again. So time is usually the best investment there.
Yeah. One interesting trend is just the number of rental properties that are available. If you look at it in Houston, there are more rental properties, like an increase, right, of 8.9% year over year, 12.7% from pre-COVID. And if you look at Dallas,
right.
the numbers are way down, right? 1.6% year over year, but from pre-COVID, there are actually less properties available to rent today than were pre-COVID. So with the massive population growth in Dallas as well. So that probably explains a lot of the larger increase in rents. I mean, it's a scarcity thing, right?
Mm-hmm.
Supply and demand. There's less supply, and there's obviously a significant amount of demand there to go up $850 in that time frame. It's pretty incredible.
That's a good point.
All right. San Antonio, and we continue to see articles that come out just saying that San Antonio is arguably the best. San Antonio and Austin are two of the best markets to invest in, not only in Texas, but the country. And that is because there's been a little bit of a pullback there. And you can see that in the numbers. The sales are down. The dollar volume is down year over year, up from pre-COVID pretty significantly. Total active listings also is up. Definitely, we'll see that in the months of inventory and the days on market, that it's longer than the other major metros that we've already covered. The average sales price year over year down 4.1% and 2.6% for the median. But the average sales price over that pre-COVID period is somewhat in line with, down from Dallas, of course, but pretty much in line with Houston. But the last year has been more difficult. And really, where you really see it is that months of inventory number being 5.4 and the days on market being 65. Those numbers are a good bit higher than the other two markets. And one interesting thing, we mentioned it earlier, that equilibrium between a buyer and a seller's market has always been, as a rule of thumb, to be around 6 months. And San Antonio is approaching that 6-month point. So it is presenting some real opportunities to buy at a discount. What else are you guys seeing here? Anything else jumping out?
That's the first thought I had, Wade, is when I was looking at these numbers, specifically that inventory amount, that is a great time if you're looking at buying. That's a great time to leverage that, to go in there, make an offer, and acquire appropriately.
Yeah.
Yeah, I can't put my finger on it as to why it's down more so than the others. Like you said, look at the 5-year numbers. Houston and Dallas are Houston and San Antonio are basically the same. But for some reason recently, I don't know if they had a little bit of an inflated run up, what it was, but it's down a little bit. And I can't figure out why, to be honest with you. But still, like you said,
one other important thing, we're going to cover this on the affordability index a little bit later on, is that San Antonio on average, the income is right around Houston, right? It's not drastically different, but the home prices are significantly less. So if you're looking at Houston, the average 421, median 336. San Antonio average 372 and 313. What's even more interesting, in my opinion, is the upside. There's upside on home values, obviously, relative to income, but the lease rates. You look at San Antonio lease rates, 1875. You've got Dallas at 2622 and Houston at 2397. So, and keep in mind, the average income in San Antonio is in line with the average income in Houston, and it's down from Dallas, but right in line. So I think there's a lot of upside potential. People can afford to pay more in rent there as the market continues to improve. So I think that's a good positive sign for growth.
You're 100% right. Like I'm looking at it, it'll be at the end, but like the income is almost identical, but yet you can get a house for on average, what, $90,000 cheaper. Like
Yep.
it's significant. And maybe that's why they're talking, because there's markets that are less affordable that you would like El Paso and Corpus. Like those are markets that are, according to the index, less affordable than San Antonio. Obviously, San Antonio is a much larger city.
Yep.
So it is a good chance, good opportunity.
Yep. That's upside there. On this next slide, Jeff, I know you're in Austin quite a bit. Your dad lives there. So what are you seeing here?
Yeah. So Austin, the home sales are down over 10% year over year. Obviously, the dollar volume follows. Active listings are up significantly more than 19 and last year as well. This is the only market we get median numbers instead of average. So I look at the median relative to the other cities, and Austin is still the highest. That 440 is the highest median, I'm pretty sure. Like Houston median is 336, Dallas is 405. So it's still the priciest market, but not by a lot. And again, kind of like San Antonio, the months of inventory is higher than Houston, Dallas, not as high as San Antonio. Days on market is higher. It's the highest in the state at 70. So obviously there's still softening in that market, but it's not, and I think it's just look at that. Look at the number at 5 years. That's still a very solid number, 35% 5-year gains. If you compare that to the other cities, only really Dallas is significantly higher. So, I know we're going to talk about Austin a little bit about why the rents are down in Austin, and we can talk about why. You can see it right there. I'm sorry, that's pending sales, but we'll talk about Austin rents a little bit. But it's still a great place to live. I don't think it's ever going to not be probably the most expensive market, just because of it's got the UT there. It's a great city. There's a lot of cool things, but it's definitely taken a little bit of a hit the last couple of years.
You ever
You
get
doing the
down
deals
to
in Austin? I mean, Eric, in the Austin stuff?
Oh, I'll just mimic the same things. Yeah, it looks very similar in some aspects to San Antonio. Again, I mean, as an investor myself, it screams opportunity, So that's what I take away from it from an investor aspect is, anytime I see those inventory numbers go up, it gives me an opportunity to go in there and acquire the way I want to acquire. So that's what that screams to me. You guys will know more about, the aspects of the fluctuations. I'm looking at the total dollar volume as well. It's going up and down, so it's got some fluctuation, which is also normal in a market. It doesn't necessarily mean that's not stable. It's got some fluctuation.
I'll tell you where another place that the numbers are really glaring. Active listings up
Yes.
from pre-COVID, 74.4%.
Yeah, that's what I was talking about. Yeah.
Yeah, to your point, I don't know if I've ever seen that many listings out there in Austin. So there is more of an opportunity. People need to sell that home, and they need to do it with some speed.
You're going to find opportunity when you see that at a 74.4% increase. You're going to find an opportunity of sellers that have been on the market longer than they were desiring to be, and may be in a position to make the deal that you're looking for.
Yeah, for sure. All right, let's look at the next slide here. Very exciting news. I think everybody in our industry is excited about it. I know Erica is. We talked about it a little bit the other day, and Jeff and I, working at the same company, of course, we're excited about it. So a 0.5 point decrease from the Fed. The prognosticators were saying probably a quarter, possibly a half. So there was some real positivity in a lot of different markets, including, the overall mortgage rate market came down on that news. And then, the stock market was boosted there a bit as well. So just a lot of positivity coming from that decrease. And also, whenever you consider what Powell said, it sounded as if there were going to be further decreases this year. And probably into next year. And the betting markets right now are looking at like another 1.75 down by the end of 2025, which is very exciting news. And we've been talking a little bit within our organization and with some investors we work with, that now is a real sweet spot. So if you're going to do a good size flip, you know, you're able to buy at today's prices and sell into tomorrow's prices, which I think with lower rates should inevitably be higher. And you're also able to buy at today's cash flow expectation if you're a buy and hold investor, and get tomorrow's cash flow expectation. So it's a real sweet spot right now to get deals, because what we're seeing is average out of pocket, and the percentage of ARV that investors are paying is still what it was before these rate changes. So I think there's still a golden opportunity at this time.
Yeah, I think to your point, you know, the high rates scared off a lot of folks. We've been talking about it for a while now. The high rates scared off a lot of investors. So the ones that were still buying were getting better deals. I mean, it's just simple. Like the percentage of ARV they're paying is a lot less. The cash out of pocket's a lot less. And that's good for investors. But as rates decrease, sentiment will get higher and everyone's going to jump back in. And that's when you're going to see cash out of pocket go up, LTVs go up. So, well, like Wade said, like it's not there yet. We're still seeing low cash out of pocket deals, but it's coming. So if you want to, you know, get into it, I would not wait, because I'd be shocked if cash out of pocket doesn't go up significantly over the next 12 months.
Mhm. I think I have a unique perspective here that might be useful to the listeners. So I run Bowden Appraisal Group. I have a Bowden Realty establishment, and I have an investment company as well. Instead of projecting, right, which is a lot of times what people are required to do, because the data is not quite out there to determine what, you know, a half point decrease is done, right? I have that information because I see the orders immediately, right? And I see the listing inventory change. I see what's happening in the offers. I probably do in my firm, I don't know, 300 assignments a week for real estate appraisal. There's been an immediate increase in buyer activity, an immediate increase in refinance, an immediate increase in pending transactions. In my real estate firm, we've had roughly a 300% increase in showings within the last 5 days. Okay, wow. So like this is just the beginning. And to tack on to what Wade and Jeff are saying, if I was an investor right now, which I am, right, and we're talking to a lot of folks that are doing the same thing, it's time to buy. It's time to buy for the anticipation, right, of what just half a point did, right? Just what half a point. And half a point, if you know a lot about this stuff, it's not direct into the interest rates right now, right? It's trickle down, right? That is just the knowledge of the buyers knowing of a decrease, right? That's just the knowledge. Then they start actually seeing the rates decrease through the next year. That buying activity is going to skyrocket again, and you're going to want to already be in it.
Absolutely. Yeah, that's a great segue to this next slide, what Eric's talking about. And just because the Fed lowered it 50 basis points the other day did not mean that the rates dropped by
there you go. Yeah.
Exactly that 50 basis points. But mortgage rates did come down a good bit. A lot of that half point drop was already baked in because it was anticipated to be a quarter.
Yeah.
But at the end of the day, we are seeing the spread between what the Fed lends at and what mortgage rates are decrease in anticipation of these rates coming down. So that's another positive. The Fed does not have to lower a quarter point for the mortgage rates to go down a quarter point. Sometimes these things happen in anticipation. So we're still seeing some positive rate movement. And I think we're going to continue to see that. A lot of it has to do with how Fed and the other Fed chair, Powell and the other Fed chairs articulate where they see things going. And I think we're going to continue to see it trickling down. So very exciting times for everybody in our space and for investors.
Yeah, to your point, it doesn't happen right. It's not like as soon as they make the cut, rates drop 50 basis points. That's not how it works. There's a lot of factors that go into it. I just look at reality, and I compared rates today, I think with one tiny little blip. are the lowest they've been in 2 years. So it's, you know, the reality is they're coming down, right? The when and how much, that's, you know, a little more sporadic, but the reality is overall they're coming down. I think they're going to keep going down, and they're the lowest they've been in 2 years.
Another big thing to keep in mind is people have a recency bias. I mean, we all do, right? And whenever rates first started going up, everybody remembered that rates were 2, or 2.5 in their recent memory. Now, everybody's recent memory is far worse rates, right? So people are going to be more excited about a 5.5 on the way down than they were on a 5.5 on the way up. That's just the way it goes. So buyers, a lot of people have been wanting to buy homes. They've been tired of being in an apartment, or they want to get closer to their kid's school or to their job, whatever the case may be. There's pent up demand. And as we come down on the rate spectrum, I think there's going to be a lot of enthusiasm. And Eric's already seeing it, like real time, right? But as they come down, it's going to just continue to be more significant. This next slide is very interesting as well. Jeff, you want to talk about this one?
Sure. So it says hottest U.S. housing markets, U.S. News Report, is June of 2024. As you can see, Austin, like we just talked about, Austin is first, tied with Kansas City, Missouri. And then if you want to look for as a Texas slant, you have Houston, which is fourth. San Antonio, we just talked about all the negative news, prices dropping, blah, blah, blah. It's sixth. So I think they probably see the same thing we do. Dallas is down at 19th. And I think if you look at the factors, mortgage delinquencies and foreclosures, which are very, very low right now. I know if people are predicting massive foreclosure and boom, I don't think it's happening. I think that ship has sailed. Rental vacancy rate, affordability, and then customer and builder sentiment. So, like we said, Austin, I think the rental vacancy rate is a large part of that, why Austin's first place. There's no foreclosures. Texas, we've said it for years now, but Texas is still a very strong, solid real estate market. There's a lot of opportunity, a lot of good economies, the tax situation, and the prices are still low relative to the rest of the country. It's not any more complicated than that. So I think that's why you're seeing 3 of the top 7 are Texas markets.
While we have you on the phone, Eric, or on the call, I did want to ask you, I know there's some exciting stuff going on in Edo with a city center style development and give us a little insight into Houston and what areas you think have some of the most upside potential for appreciation, and any other information you may have on some markets.
Sure. It tends to be, Interloop is a key area. So inside of 610, the areas of the Heights is still very, very popular. I've actually seen a growth pattern in Lazy Brook, which is an interesting little market west, where they have some restrictions, which is useful for investors to know. Actually, the Lazy Brook is inside the loop of 610 near the Heights market. Okay. But Lazy Brook area is got restrictions for new construction. And so what ends up happening is you get more of a flip opportunity, right? Because they don't allow you to scrape the home. And so the land value remains nice and tight for you, right? So your investment is really good in the land, but you don't have to compete against what a new construction builder can build, say a townhouse or something like that. You can go in there and buy yourself a 3-2 and put the work into the property and see the return, because the market is capped. It's like an encapsulated area. I like that. I love the Oak Forest area. It's still very, very, very popular. My recommendation, if you're looking at Oak Forest, is be careful when you're looking at an investment opportunity. The majority of the value is in the land, right? And so when you go to potentially consider a flip or even a buy and hold, if you're going to buy one of the older 1950s homes in there, make sure the home is of quality enough that the market's going to withstand it, right? Because you're still going to have some new construction in there. But it's a fabulous investment if you can get into it right above the land value mark, which there are plenty of sellers. There are plenty of sellers in there that are willing to sell their house, their older homes, the 1945, 50, 55 homes around that land value. And then you can hold that property, renovate the home, and the rents are going to skyrocket in there as well. So I like those areas. Edo, like you said, is a very popular area. Any of the midtown locations, these are, any of these areas are growing substantially. South Houston, we're seeing a lot of that stuff, especially in y'all's company. Lots of great renovations going on down there, good deals to happen. But I'd say, inside that 610 loop or just north and south of it, those are the hottest markets and the best opportunities that I've seen.
Awesome. All right.
Thanks, Eric.
Very good insight. All right, let's
Next
look
slide.
at this next slide. Texas and national rent trends year over year. As rents across the country go up, Austin prices continue to fall. And I think Jeff, you mentioned this earlier, not only in home prices, but also in rents. Whenever COVID happened and people were working remotely and so many of these major tech companies are moving into Austin, there was just so much excitement and people were overbidding everything, and that market had to correct. It went up too fast, too quickly, and it was a little bit unrealistic. And I think it had to pull back a bit to get back on a reasonable trend, and that's what we're seeing. It is interesting on this. I'm sorry, go ahead.
No, go ahead. No, go ahead. I would say we'll get to the next slide. There's two parts to that story. There's, like you said, there's the massive run up that we had during COVID, everyone moving to Austin. And then we'll get to the next slide, but builders are just crushing Austin right now. But anyways, what were you going to say about, you said there's something else.
I was just going to say one other thing, which is of the Texas markets, the big three listed here, Houston is the biggest growth year over year at 2%. Dallas is only showing up 0.2, and Austin being down. Now, as you remember, Dallas did have the biggest run up since COVID, but the last year has been very solid for Houston. So the good trend there.
Yeah, looks like Austin, like Dallas passed Austin. They crossed each other. So Dallas is more, like you said, it's more expensive to rent in Dallas than it is in Austin.
Yep.
But if you go to the next slide, see, so this is like what I said, there's the big run up, but then this is huge. Look at the difference between, so this is developers are building a lot of homes in Austin. The number of homes permitted per 100,000 people in large metros in 2021. Like this is number one by a mile. Like it's basically 2x of the second place city in Phoenix. So there was just, I think, people were realizing what a nice market it was, and developers went crazy permitting new homes in Austin, and those are finally starting to hit, right? So you have a lot of inventory coming online. That's going to drive part of this, in my opinion.
Yeah, I think, now keep in mind, this is the number of homes per 100,000 people. So the total in Dallas, the total in Houston is still greater, but as a percentage of the population, Austin is through the roof.
Yep. Next slide. So I think this was just in there as an homage to our previous guest. If you guys remember, I think it was last month, Stephen Curtis at NRL Mortgage was talking about how I think his kid was going to go to Lubbock, go to school up there, and he was going to start buying up properties. And, case in point, America's 10 easiest housing markets for home buyers. They're all in Florida except one, little Lubbock, Texas up there, number one. So not that it affects, we don't do any Florida stuff. So this is really just more of an homage to Stephen and his Lubbock ambitions. He's not missing number one in the market right now.
Yeah, that was funny. On a side note, just to explain what the easiest means in this particular context is that it means it's kind of the easiest for a home buyer or an investor to buy a home because of some perceived softness in the market, right? Like there's more days on market, more inventory, whatever the case may be. So a lot of investors are aggressively approaching that Lubbock area, doing some good deals. It is interesting that so many are in Florida, because that was perceived to be a really great market coming out of COVID. But it seems like there's some softening there. That this Realtor.com report's picking up. If this, as I understand it, this is a national breakdown, and 9 are in Florida. That's pretty shocking.
Yep.
All right, so there's some more information here on Houston and, well, the other major metros as well, but how Houston is really leading the charge here in sales volume from June to July. So, most of that information we show on the first page is year-over-year information. So it's hard to see trends from there. So we wanted to pull this in. Eric talked about it within his organization and the big jump we've seen recently. This was already showing a pretty big jump from June to July before we even had rate decreases. We're only hearing rumblings of them. So I can only imagine where we're going to go from here. But look at that month-over-month sales volume up 21.7% in the greater Houston area, 18% Dallas, San Antonio 16, Texas overall 15, Austin being a little bit below the other numbers. And then the month-over-month median home prices also up. So that's one interesting thing on that previous what we did at the beginning, covering the 4 major metros. We have a pre-COVID to now number, which is like a 5-year mark. Then we have a year-over-year. So this is more current trends, and definitely some positivity there, along with what Eric's saying, seeing a big boost based on this half-point drop. Anything else you're seeing here, Eric?
No, I'm on board with you. Yep.
Jeff and Eric, what are you guys seeing on this slide?
So Zillow housing data, Texas metros. If you look at home, like we talked about, home values, I just look at the year over year, right? Austin down, Dallas down slightly. Look at little El Paso up 3%. It's also nice to look at the rents. You're gonna get an idea for where rents are going. And looks like Austin is the only year over year market where it's down. So, like we've been preaching for a while, buying rental properties, even if the cash flow is light in the beginning, it's only going to get better as you go. I don't know, Eric, if you see anything different. You look at the inventory.
No, I see what I'm looking at in Houston. It echoes, what I see in, my lending institutions that are sending the orders over. Houston is just generally just a stable market. It's 0.4% is nothing to sneeze at, when we're looking at home values. But when you're looking over at overall trends, you can see McAllen and El Paso, some of these other cities that are having, larger year over year, or even Austin that's got the same going down. Those are numbers that show more of a trend, right? The 0.4s or the 1% plus and minus, they're more of a stability, right? And it's beautiful to see that, just another stat or another source of stats here is Zillow, just another source of stats that's kind of echoing the same thing that I see on the ground, right? I'm more of a ground guy here because I have the knowledge that of the private knowledge, right? The private knowledge of assignments that nobody else gets to see, right? And the stability of a market is echoed here in this data.
Next slide.
Sure.
So this is interesting to me. This is the typical home buyer's down payment is a record 67.5, 15% from a year ago. I wish this chart went a little further back. I would love to see what it was like starting in 2000 and going up, but this is kind of what we talked about. Like just the average down payment, it's 67,000. If you look just, 2020, early 20, it was in the low 20s. So in just a 4-year period, it's gone from low 20s to mid to high 60s. Like it is a significant jump. So, there's a lot of folks that probably can't afford that. So if those numbers start trickling down, you're going to have, like I said, you're going to have a lot more home buyers. Rates will help with that. I don't know if any special programs are coming online that will help with that, but it's just it's shocking to see how much it went up over just really well 4-year period.
Yeah, that limits your buyers whenever the down payment is that high. Right now, we have the problem of the down payment being that high and payments being extremely high because of where rates are. We're going to start to see the payments come down significantly as rates reduce. And the reality is this down payment number, though, is not, I don't think it's going to be drastically reduced because of interest rates coming down. It's that's starting to become a little bit more of what we're seeing in the market because of this home price appreciation.
Mhm.
Home, and a lot of this is outside of the state. I mean, candidly, if you look at other parts of the country, California's, the New Yorks, and other parts where people are more affluent, their home prices have gone up even more. Big reason why, if you remember on that other chart, almost all the areas where there are lots of new home construction permits are in Texas or less regulated states. California, I think for the better part of 5 years, both Houston and Dallas have had more open permits for a new home construction than the entire state of California, right? So that's a big reason why, like we talked about earlier, supply and demand. As long as there's less supply, the price is going to keep going up, and we're going to have pressure on this down payment. Just the reality of it. All right, this next slide shows how much equity Americans have in their homes, and only 0.3% of borrowers have negative equity in their homes. That's a pretty incredible number. If you look at that negative equity number going back to 2013, it was, I don't know, that's
10%.
10%.
Yeah.
And I can tell you this number back, if you go all the way back to 2008, 2009, that number was way up, which really drove the foreclosure crisis. But there's a lot more equity in the properties today. And so that's, Jeff mentioned this earlier, and I know Eric and I have talked about it at times in the past. It's hard to see that foreclosure crisis people talked about if we had this much of a run up on interest rates and you didn't have those problems. And I think a big reason is if somebody needed to sell their home, they could lower the price to where they could do it, even though rates were high, right? I mean, there was room in there to do it if they had to. Whereas before, I mean, there were no willing buyers. Even if you lowered your price down to where you were breaking even, there just wasn't enough of a market. So this speaks to the stability of the real estate market in the current moment. A lot more equity. And then also, as a reminder, we've shown this on slides in the past, the credit quality and loan product quality of the U.S. mortgage market is incredible compared to where it was back then. Back in the day, whenever there were stated income loans, no income loans, neg-am loans, negative amortization loans, where your payment actually goes up every month instead of down. 125% mortgages in other states, not necessarily in Texas, but a lot of other states had 125% upfront. It was the Wild West back then in many ways, and we just don't have that anymore. So a lot of stability in the market.
Yeah. The only thing I'll mention, and we'll move on, is, like I said, that's a lot of equity that people can tap. So, about 4 slides ago, we said now's a good time to start buying because you can get good deals. This slide's telling people, if you own a home, there is a great chance you have a lot of equity. So talk to somebody about pulling some of it out to get more properties.
For sure.
Yeah, I was shocked. I saw this and I was shocked. The average LTV, or loan to value ratio, the average LTV ratio across all loans in the country over the last decade. In 2013, we had a 70% LTV. Now it is less than 50% on all mortgages. That is a huge drop. And it tells you, like you mentioned just a second ago, how stable the housing market is, right? I don't see, if everyone's got a ton of equity in the property, things go bad, sell your house. Even if there are less buyers, there are still enough where you can drop your price. You have tons of equity to get out from underneath it without facing foreclosure. There's tons of options, not to mention off market, which can close, so what we do, right? So if somebody gets in a situation, they sell their house off market, we're closing in 10 days. Sometimes even faster with appraisers like Eric. I know we only have a couple slides left, and if it's okay, I did have a question for Eric. Um, since you're, an appraiser and I've seen probably thousands of reports over the years, I don't want to put you on the spot, but could you think of maybe like two of the most common mistakes investors would make in trying to estimate their ARVs? Because they're out there trying to find deals, and it doesn't always go well. So, what are maybe the top two reasons people have an expectation of X, but they're off that you see?
Sure. Top two is hard. I see a lot of great acquisitions. I see a lot of well thought out, renovations, whether it's for a buy and flip or a buy and hold. Those can be two different things with what you want to do to a property. I'd say the number one, what else? I'll shift and say, points of advice. Okay. So point of advice number one is to be honest with yourself. Okay. When you're looking at your comparable selection for ARV. And what I mean by that is when I teach realtor classes as well, it is a buyer, right? Is a buyer the same buyer for your comp as it would be for your subject property that you're considering for your investment? That has a lot to do with a few top items would be locational factors, right? Locational factors, the size of the home, maybe even the level of renovation you're willing or considering to do. Okay. And what I mean by being honest is when you're selecting a comparable, you may be tempted to select the real shiny one, right? The one that is the highest sale that may be similar, right? It may be similar in the age and the construction quality and the size, but you had to go to the other side of I-45 to grab it, right? Or you had to go across in other markets, right? In Austin and Dallas. So just think about like a major market boundary, a river or a school district or railroad tracks. I mean, different things can be boundaries, right? Does not mean that you can't go there, right? I mean, that's not a black and white rule. It means there needs to be a reason to go there, and it can't be price. It cannot be price, right? So make sure you look around in your immediate area and be aware, if there's some crummy sales in there, we're going to find them too. Okay. And so be aware of what's occurring in that market, right? You might find a renovated sale that is not speaking to, what you were hopeful for on the property. There may be a bunch of them that are kind of on the upper side, but not quite exactly what you would hope to see on the property. You got that one that's sitting really high, right? And you're hoping you're going to be able to sell that, right? But, our job is to look at, what is the assumed value after a rehab is reasonable, right? Not the highest and not the lowest, but what is reasonable based off of that rehab. I guess the second aspect would be to acquire appropriately, right? And that might be tagged on to that, right? So most of that and most of the seasoned investors know this, but the acquisition is usually the most important aspect of that. So, finding the right purchase price, not jumping onto something that doesn't feel right, right? Those comps aren't adding up the right way, and the seller's not budging. Well, maybe that's not the right property for you, right? And maybe it's not the right one to go after. But yeah, the biggest pitfalls are, if an investor shares, maybe a comp or two that they were hopeful for. Oftentimes they're great. And that's not, there's plenty of wonderful investors and smart investors out there. There are occasions though that I get something that isn't a comp, guys. It's in the wrong market, or they have done substantially more in the renovation, right? And the renovation itself maybe need to be, you can look at that, right? And it happens a lot. We were doing just a couple of them, Wade and Jeff, on some recent ones, right? Where, if we take a look at it and you're trying to achieve an ARV, right? Maybe we go back into that rehab list and add a couple things, right? And the cost of those rehab items may substantially return a number that's far over cost, right? And it may be an investment opportunity for you to understand that if you're looking at that comp and it is a comp in the market and it's appropriate, but it just has a better rehab, you may want to look at what you're doing to the property, right?
Yeah.
If that's going to be a true comp, then you also need to mimic a similar level of the rehab.
That makes sense. Yeah, and I see, like you said, neighborhood hopping is a big one. You have two comps that say one thing in your neighborhood, and you have the nice one, but it's in a different neighborhood. You really, it's a hard time using that. And then to your point, I've seen not a lot, but I've seen some rehab budgets just not meeting the other side of the market, right? Not meeting that top comp. If you're using A, B, and C, and A, B, and C are better than yours, and that's a problem. Now, it is a balance, though. Like, I don't think you need every little thing in your house to have every little thing. So it's not as simple as like, yeah, because then you can't make money if you have everything nice. But it's just a balance between making enough of them similar, and you have to have some superior, right? You can't use a comp that's 100% rehabbed if yours isn't that way. But if it's got some things that are better, you don't have to match every single one, but you may have to have a few that are better than that one to use it.
It goes back to being reasonable and honest, right? When you're looking at those comparables, are you being reasonable and honest to yourself as an investor when you're looking at a sale, right?
Yeah.
If you're in this market and you're looking at a buy and hold or buy and a flip, you should have the base knowledge of what you're looking at. And if you're looking at that sale and you know that if you were in front of a jury and you said, this one right here has got all this stuff and mine is going to get half of that, is that the same, right? It's that simple, right? It's that simple. And that's how we're going to be looking at it. And to tail in on Jeff, that's exactly right, Jeff. You do not have to do a full rehab, right? It depends on your acquisition, right? It depends on where you acquire the property. The net profit may be similar if you do a minimal rehab, right? It depends on what you acquire the property for and what the market is looking to absorb and with your buyers, right?
Yep.
And that's an educated decision. And it doesn't have to be all on you. You've got a great team. The listeners got a great team with Jeff and Wade and their entire team to help with those decisions. You've got my contact information. Always happy to discuss these things and do some consultation if it's necessary for these markets to try to help an investor understand, what is the best option for that profit return. But you're surrounded, you're on this and listening to this, you're surrounded by people that love what they do and know what they're talking about.
For sure.
Yep.
We got a few minutes left here. I'll briefly cover this slide, and that is just saying that, we built an enormous amount of homes from the 1950s at the beginning of this report through 2008-9, massive drop off, and then really still have not built more homes than were built at times in the 80s, 70s. So this is a big reason why home prices continue to grow, is there's just not enough inventory, not nearly enough. And this chart really shows it. Despite the population going up enormously, we're building fewer homes than many decades of the past. Real quick, the rental vacancy rate basically flattening out recently, but being way below where it was in lower rate environments. One of the good things about being in a higher rate environment is that a lot of people aren't buying homes, so landlords do get some advantages there. And that's one of the reasons why we're seeing that vacancy rate being very low relative to other times. Then I did want to just get to this affordability index and cover the three markets. So whenever you think about it, I look at this and I say, you got three markets here where you're looking at two of the largest cities in the US with Dallas and Houston, and one of the more attractive cities that people really want to be in there in Austin. And they have a lot of the similar amenities to the Los Angeles and Miami's, New York's of the world. But the affordability is significantly greater than any of those. So that's one of the things that's exciting. What else jumps out from you guys on this report?
I just went right down to San Antonio and saw that exact, again, a different data source saying the same thing, the affordability versus income. We were just talking about that market.
That's incredible, right? Like you look
It
at
is. Yeah.
Dallas income 66 and the average price is 449. Come down to San Antonio, the average price is 271, and the average person's only making 4K less.
I
Yeah.
know. Yeah,
That's
big difference.
that's a major difference. I looked at Austin. I mean, we talk about like, the influx of folks moving to Austin. That's that 90K. That's a big number. Like that's a lot more income. Plano's seemingly a small sample size, but Austin's not. And that's a significant income bump relative to the other markets.
Now, admittedly, in Dallas, they seem to segment that market a lot. You got Irving, you got Plano,
Sure.
you got Fort Worth, you got Arlington. Like there's a lot of markets within that market, submarkets within that market, where the average income is a good bit higher, right, than the 66 overall for Dallas.
Yep.
So there's noise in that number.
And I kind of just laugh up there at Los Angeles. Look at those numbers.
Yeah, that's I don't think a lot of folks, I don't know what the home ownership percentage is up there, but I'm guessing it's obscenely low.
Yeah, $54,000. You're not buying a $900,000 house, but it's interesting just the income gap there with who the homeowners might be and what their income is compared to what the median or the average income is for the area.
Yeah. I think it's just, if you look at those markets, I mean, LA, Miami, even New York, like people are willing to basically live there and rent because they like living there so much. That's basically it. Like but the actual place itself is such a draw. People don't care. There's like, I'll pay rent. I don't care. I don't need to buy a house. And that's what keeps those numbers propped up.
Mm-hmm.
I was in San Diego a couple of weeks ago, ready to throw it all away just to move to San Diego. It's just because, there's certain spots are just so nice and lovely. It drives those kinds of markets like LA,
Right.
Yeah. Low humidity, 70 degrees.
There's no sweating. There's no sweating.
All right, Derek, I don't know if we have time for questions today, but I think we could go over our award winner, maybe squeeze in one question. Derek,
Definitely,
you there?
yes, we have half off your first hard money loan processing fee goes to Ivan Lopez, wins today's drawing.
Congratulations, Ivan. And do you have one question for us?
And the one question we had is somebody was saying, looking at the current rates as they've just happened and then considering future rates, what is the approach for a cash out refi as far as timing and first steps?
Well, one thing I would say is that that's like asking somebody, let's say, do you want to borrow stock on margin if you know that the stocks are really going to go up, or do you want to wait until they're already up? Right? Like, so my point being, you could wait until rates are lower to do your cash out refi, but you're going to miss out on the opportunity to get better deals, which you can't get in today's market. Jeff will tell you that there was a time when rates were lower. The average out of pocket we saw on a deal was 45, 50K. Right now it's 25K.
In certain markets, it was that high.
Right now it's 20, 25K. If you're willing to go a little further out, you might get 15. You're just not going to see that anymore. So, I think it's a nominal difference in what your payment will be on your home equity loan to go up 1 or 2%. It's not that enormous of a difference, but the difference you'll be out of pocket on the 4, 5, 10 transactions you do because of taking the home equity loan, I think that's where you'll see the big difference. So in my opinion, the time to buy is now, and the time to try and get equity to fuel your investments is right now as well.
Mm-hmm.
Right. Well, that's what we have for today. Thank you, everyone, for joining us on the Catalyst Real Estate Market Update. Any last words, guys?
I just thank you for joining us, Eric. Some great info. Really appreciated you giving so much of it to the people out there. Great stuff.
Thanks,
Thanks for the invitation. I was happy to be here, guys.
All right, guys. Have a great one. Thank you, Derek. Thank you, Jeff.
Thank you. We'll see everybody next month.